In this video, I'll walk you through, like a baby, step by step, what liquidity is and how you can apply it to your trading. And I'm going to be covering the three types of liquidity, which is transactional liquidity, structural liquidity, and inducement liquidity. And also, I'm going to be giving you the three rules guiding the structural liquidity, and lastly, POI, which is point of interest. However, in my previous videos, I've discussed what market structure is, which tells us the direction of the market, and also structure called an algo market structure, which gives us a specific zone of the market. However, liquidity is the money that pushes the market, giving us our overall direction of our POI, which is point of interest. Now, you want to know that liquidity is as simple as knowing money, right? Liquidity is money, because without liquidity, price won't be able to go from point A to point B, either from point B to what? To point C. So if I come right now to this chart, basically my previous video, which I made about market structure and algo market structure, I made it simple, that which is to say that markets, they tend to do something called a sweep right here. Given this a swing structure, then once you tend to sweep this way, we are expecting what we call a break of structure, right? So this is a break of structure. Say that in our previous market structure, we talked about that here is our break of structure, right here is our sweep, right? So, which is to say, from this zone is our protected low, which is our swing structure, and also this zone as well, right here at the top, is our swing structure. So from this point to this point are called the swing structure. However, we talked about algo market structure, that if we tend to see something like this, let's say on algo market structure, we talked about that we are supposed to have something called the ABC model, which is to say, once we have the market do something like this, sweep, another break right now, we tend to have the market to, come down to this low, give us another break. And we tend to say that this first zone right here down below is our A, right? And also this zone right here is our B. And whenever markets tend to, take out this B, you're seeing right here, take out this B, what do? We tend to do what? Buy and then make profit, right? However, this is the model which I teach you in my previous video, where elaborated on market structure and algo market structure, but whereby you have multiple B's. Let's say your sweep right here, the first break of structure, second break of structure, and you can see other B's. Now, where are you tend to trade up from? So that is where this liquidity tends to come in. That's where the types of liquidity, which I'm going to be guiding you through, explaining in detail, tend to come in. And we'll have that of the transactional liquidity, and this type of liquidity tends to be correction, right? And when I mean correction is sweep right now, let's say we have something like this right now. Transactional liquidity tells us that for every break of structure, price gives the high to sell right now. After every break you have in price action, basically like this, you have any break right here, you're expecting price to come down and also sell, right? For example, we've gotten a break right here, a break of structure of this particular low, so price gives a high to sell back, right? This is what transactional liquidity does, right? For every break you have, after price taking out a particular break of structure, you are anticipating a reversal, which is called a correction. Is that simple, right? Now you understand that of transactional liquidity. We have what we call the structural liquidity. Now, the structural liquidity is used for continuation, right? And is usually the last high before the main high. If it's in a buy position, it's usually the last low before the main low. That is if you as well looking out for a buy position. However, for the sell position, is usually the last high before the main high. Now, for example, let me show you something real quick. Now, if I open up this right now, I have something like this. First and foremost, we all know algo market structure is sweep, right? Break of structure, another low, break of structure. So let's say you have something like this again. Now let's say you have something like this, and then you can see basically there are a lot of multiple Bs right now. Now, are you tend to buy off from this zone, or this zone, or this particular zone, or this zone? Right now you can see there are a lot of Bs. Now, structural liquidity tells us that if we see any structure or any price action like this in a bullish trend, we tend to also get a exact continuation from the last low before the main low. Now, looking at this, stuff I just drew. Now, if you want basically looking right here, there are a lot of Bs. You want to see that the last low before the main low is this particular one, right? This particular one you're seeing right here, right? This is the last low before the main low. And where is the main low, which I'm talking about, is this one right here, right? And what are you supposed to do? That you want to make sure you wait for the market to come to this zone, to this last low, before you see any continuation. However, markets will not just come straight to this zone. It will also play around, come to this zone, go up again, come to this other zone, go up again, then before it now finally come back to this lower low. So when you tend to see the market coming back to this particular zone right here, maybe, and you're seeing the market is pumping, you don't tend to rush in the market to buy. All you have to do is to just wait for it to take out all this low, all this transactional liquidity and stuff before you tend to buy. Is that easy? So that way you won't be losing out on money, you won't be getting unnecessary loss. That way you will have the exact continuation from the last low before the main low, right? And I'm going to be showing you in a chart example, so you tend to see this thing real life, right? Now let's say you have this in a sell position. So let's say you have this kind of setup of price action in a sell position. Now all you want to do is something like I said, you're not tend to buy from this zone, neither you tend to buy from this zone, or this zone, or this zone, or this zone, or this zone, right? Like I said, you want to wait when price tend to take out the last high before the main high. And first and foremost, you want to know that the main high right here we're protecting is this guy right here, right? You can see is this guy. This guy is the last high. And what is the high before this particular high? Then is this particular guy right here. Right now, all you want to do that whatever price tend to play out, it must come to this zone and tap on it before you tend to sell if you're selling, right? Now, once price did not tend to tap on this zone, you're not expected to sell. So whatever it tend to do from, maybe if you go from this zone right here, if it sell off from this zone, maybe this first zone to this zone is not valid, or maybe sell off from this zone is not valid. So you must make sure you come to this zone, which is the last high before the main high, before you can sell, right? And that way you get the exact continuation. So now you've understand what it is, what the structural liquidity is, which is known as continuation, looking out for the last high before the main high, or the last low for the main low if you're looking for a bullish trend. And you've understand what transactional liquidity is after every break of structure, there must be a sell, a reversal, a retest before another break of structure. Now, we want to talk about what inducement liquidity is. Right now, I'm going to clean up this dashboard. So inducement liquidity is used for expansion. Now, for example, let's say you have a sweep right now, for example, and then let's say your first break of structure, right? Now, inducement liquidity comes in. For example, you have a sweep and then a break of structure, which is your swing structure, and the market is bullish right now. However, if there is no structural liquidity, which is another low to push this market to the top, what is resting down below right here is inducement. And 90 to 100% of the time, market tend to take this out, which is this low you're seeing right here, take it out, and then what you see is this, right? And if you tend to see this kind of market, right, you want to know that this is a inducement liquidity, and most of the times inducement liquidity is risky to as well trade up from, because you might have a setup and you're expecting a structural liquidity to happen before you buy, which is your B, then and the market tend to take it out, and then you see a huge pump, right? That way you're going to be losing a lot of money. Now I'm going to show you a charted example of an inducement liquidity, and also my experience, what it has done in my trading, right? I'm going to use this token, for example, called Launch a Coin. All right, looking at this, my setup on Launch Coin USDT. Now if you watch, basically you can see basically I had a sweep right here. Let me get my cursor. I have a sweep, right, which is this low, my expected low to be protected, the break of structure, right? And what happened, I have another low right here and another break of structure, which is to say this is my B, right here is my B, and here is my B. And what was I expecting the price to do? Price should tend to come to this zone right here, from here to this point, then I tend to buy up from. Now what happened is price did not come to the zone. Price also take out my protected low and also went below. And what really happened right here was inducement liquidity, right? My low, which I was protecting, could not hold, right? And price tend to take it out. And then if you watch what happened after taking out my low, which I was protecting right here, price tend to start going to the top. That is inducement liquidity. And this kind of action always happen on new token, right? If I also tend to show you more token, you will see that more new tokens which I have seen this kind of thing happening, you will see that the same inducements tend to happen. Expansion happen whenever you tend to have a setup on a new pair, right? So basically, in summary, when you don't get structural liquidity in any of your trade setup, you want to avoid it, right? All right, on this pair called dark USDT, the same thing which happened on Launchcoin USDT also happened on dark USDT, which is called the inducement. Now if you look at this setup right here, which I anticipated, now if you look, basically I had a sweep right here, first break of structure, another low, and then another break of structure, right? Which is to say, right here was our protected low, and also right here was our our B, which is our second low. And what are we expecting now? For any time price tend to come to this zone, what happened is we tend to buy up from, right? But now what happened was price tend to take out this low which we are holding, right? This low could not hold the price, and it take it out and then tends to go to the top. And if you want, basically this is what happened basically. So the coin even tend to die off, right? Now you want to see that whenever you see a new pair, avoid it, right? Because it's likely most of the time tend to have inducements in it. Inducements tend to rest at the low. Right now, if you tend to see coins that have been like maybe 6 months and above, maybe you can trade them up, because whenever you didn't see any swing structure, or you didn't see structural liquidity to hold the coin, you tend to sweep off and then take out the particular low or the high which you're holding. And what happened basically, instead of this right here, instead of this B to hold, it didn't hold. No, however, it tends to take it out and then also take out our protected low, which is, if we tend to enter this trade, we're going to be losing out on money, right? Is now for structural liquidity? Let's say, let me use this token for example. Let me use ENA USDT perpetual. Now this token I'm gonna use 4 hours time frame. All right, this is the setup basically. Now we have this, our stuff right now. Now basically, first thing first, we have our sweep right here, which is our protected low, right? You can see we have our protected low right here. And then what happened, it take out this structure at the top and then giving us another low, which is here, which is this one right here, right now. And also it went to the top and also give us another break of structure, which is this right now. We've gotten our ABC model, and this is our C model right here. At the top basically is our C model, right? If you don't know. All right, so this is the swing structure, and right here is the swing structure, right? Now, whenever price tend to take out the B, which is algo market structure, we tend to buy. Now, for structural liquidity, now you don't just buy up. Now, if you want basically, price first of all came to this zone, and have a little retest to the top right here, but that was not a good one. That was not the exact one. So this stuff that happened right here was transactional. Now what really happened is wait for price to take out the low before the main low, which is our structural liquidity. Now we're looking right here is the low, and then the low before this low right here is this particular one. And what the price did, price tend to take it out, right? And how did it happen? It came to this zone and take it out, and then we saw a real continuation, and this continuation is the major one we are expected to catch, and then we'll make money off it. Now if you would basically, now what price trying to do is trying to do a change of character. So once it come back to this zone, then it will now go to the top. Now this is where order block and QMRO on point of interest tend to come in, right? And that being said, if you're enjoying this video, I want you to like this video, subscribe to the channel, turn on the bell notification so that you're gonna be notified whenever I drop amazing bangers like this on the channel. So without further ado, if you're understanding everything I'm showing you from the beginning up onto this point, I want you to also comment down below liquidity, right? So without further ado, I'm gonna go ahead and guide you through what POI is. Now, in simple terms, POI is called point of interest. Now this is like a specific zone which you're interested to trade up from, right? Now basic market structure gives us a direction, right? And then like I said, algo market structure gives us a specific zone, which is something like this to trade off from, or a direction of entering, like what I just showed you here on structural liquidity. While structural liquidity gives you the more specific zone, right? Like I just showed you. When POI comes in, it gives you the overall entering or the main entering of your trade setup. Because sometimes when you get structural liquidity, there are also other conflicts, there are also other Bs, and most of the time you tend to have a wider stop loss, a wider A, which is your stop loss, and then seeing your B at a very high range, right, which gives you a very unnecessary small risk to reward. However, if with your POI, it gives you that specific entering and increase your risks to reward, right? Now for example, let's look what a POI is. Now for a POI, we tend to look out for the two types of POI, which are the order block and the QMR, right? Now order block is simply the last bearish candle before a bullish move in a bullish trend. Let's say we are having an uptrend like this, so the last bearish candle before a bullish move is an order block, right? But in a sell position or in a short position, the last bullish candle before a bearish move is an order block. Now for example, on this bullish move right now, you want to see that looking for the order block right here is, let me just zoom up this stuff so you tend to know where the order block is. All right, looking right here on this particular zone, the order block right here is this bearish candle. You can see this one right here. Let me use this something where specific to identify it. All right, so this red candle you're seeing right here is an order block, right? This is where price tend to tap in then before going to the top. And if you look at this first setup, now what happened after price came to this zone, which is our B, right? Looking below the wick right here is our B. What happened? Price tap into the order block and then boom, right? But before price tap into the order block, it also gives another order block right here. Now this order block is also the bearish candle before you see the major bullish pull, right? Now you've seen this order block right now. It's the same thing. After price tend to top pump right here, it's going to come back to this order block, then before you go finally to the all-time high. Now you don't just trade up from just the order block, right? You also use another co-influence, which is that of the QMR, right? With the combination of the order block and the QMR, you tend to have a specific zone to trade up from. Now if you don't still understand what an order block is, example, let me just make a diagrammatically example. This is a box, this is a short box. Let me use this as a red candle, right? This is a red candle. Now I'm gonna have another candle again, which is here. Let me have this right now. All right, so looking right here on this diagram, now you want to see that from right here, this red candle, whenever you see a red candle before a bullish candle, is an order block, right? Now if you want, basically all you're expecting price to do is to come to this zone, and once price tends to come to this zone, example, let's say price tends to come to this zone, what's gonna happen is it will now go to the top. Is that easy? Now boom, take out this order high, right? This also apply in a sell position. For example, in a bearish action or a sell position, whenever you tend to see a bullish candle like this, a bullish candle, then and a bearish candle, right here is the order block. Now once you see this bearish pull, now what price tend to do, it will also come back to this zone, and then what happened, it will now sell fully, right? Now it's from this order block you can tend to take off your sell position from, right? But the order block does not give us the exact position to sell off from, right? So we tend to use that of QMR with that of the order block to get the exact sell position or buy position. And what is a QMR? A QMR is a Quasimodo reversal. Now what is a Quasimodo reversal? All right, so the Quasimodo reversal is just like the order block. Instead of the order block to hold, it fails and the price break, right? So it's, for example, so a Quasimodo reversal is just like an order block, right? So instead of this order block right here to hold, right, it fails, right? It come down to this zone. Let me show you. It take down to this zone, right? Then before going up, right? After going up, it will have to come back to this other block, right? Before you now see a rebuy or a resell, right? Example, let me just show you what I mean. Now, if you want, basically right now, this is the order block which I just drew, right? Now, what happened after the bullish pump? Price came back to this order block, right? Now, I know you will say once you get to the order block, this is where you tend to buy, right? Now, you don't just buy once you see price come to that your zone of the order block, right? You must wait for it to as well fail. Most of the times, 80%, 70%, it tends to fail, right? Once it fail, then you will see a pump to take out this bullish pull, and after it has taken out the bullish pull, it will now come back to that zone, right? To the order block zone. That is where you can tend to buy, which is to say you must see a fill of the order block, a break, and then another low coming back to the order block zone before you can buy, right? It's also applied on the sell position. You must see a fail of the order block. It must fail coming, taking out this, right, like this. Then after which it now take out this zone, right? So after it has taken out this zone, what you're going to be expecting is this sell position will come back to this zone. No, it will not fail this time around to exactly come to the order block point. Then from this zone, you can then see your overall sell position. That way you can take your sell position from this zone and then your stop loss right here. And that way your stop loss will not be too big, it will not be so small, which is the high risk to reward. Right now you can see your entering will be here and then your stop loss, compared to when you have your entering being maybe at the low before the main low, and then here. That way you see that your stop loss will be very big. You can be losing a lot of money, and also most of the time the TP won't be that much. I've been an experience of that. I've gotten a lot of setup. I tend to enter with a big stop loss, and at the same time I tend to see little take profits, right? So using this order block strategy and then the Kusimado reversal strategy, trust me, you will have a very high risk to reward and then tend to make more money for yourself, right? So that is what it is right here, using that of the Kusimado reversal and the order block. Now I'm going to show you a practical example what this is, and then lastly I will now give you the rules you need to follow when you're trading structural liquidity. And these are 3 rules you must follow if you want to also trade structural liquidity. So coming back right here, let me show you something real quick on the chart. Now I'm going to be using this particular one as an example. I believe you all understand. If you understand, comment in the comment section, understand. That way I will know that you all are really watching this video to the end and you are so getting real-time value from this video, right? Now let's say I come back right now to this particular setup. Now if you watch basically this setup, I took this setup and I got a lot of profit from it. And now what is it trying to do? Now you want to see that first. Remember, we use QMR reversal. You want to see that first it took out this order block, right? This order block did not hold, right? But however, it formed a order block trying to letting you know that this order block was valid then before it went to the top. Now what does it happen? It's not changing character to come back to this zone. Now what would this trade do? This trade will come back to this particular order block. It won't fail, it won't come down below, it will just tap to this order block you're seeing right here before you see the exact pump. Now if you tend to catch this from here and enter, then you will be your entering will be at this zone, let's say 0.278, and then your stop loss will be at 0.2589, 0.2683, and then your stop loss will be at 0.2572, and you can take it maybe to, let's say, maybe to this other high because it has broken a very big high right here. Maybe you can take it to this high of 0.8275, and let's say I get a measurement from here and then place it right here. From here, the measurement, let's see how many x we're gonna make from it. All right, so that's gonna give us equivalent to over 200x, right? 200x from this zone right here. We tend to enter the market from this particular zone which I just showed you, right? And we're going to be having our overall TP right here at maybe either 0.8 before coming down, and this is going to give us over 198% in ROI and making you a lot of money. And trust me, using this strategy you can make more money for yourself than you just entering the market blindly without knowing what to do. However, if you want to also get the exact zone, that's what we call Fibonacci tool. All you want to do, let's say you want to get the exact zone for where to trade up from, you can tend to use Fibonacci zone using the 50% zone to enter the market, which is the discount zone to enter the market. So if it's not at the discount zone, you tend not to enter the market. And how do you do that? Let me delete this measurement right now. Let me get a Fibonacci tool. So this is our Fibonacci retracement tool. Now, for you to use your Fibonacci tool very well, you must then use it from the break of structure, which is here. I'm gonna use it to here to the lower low, right? Let me widen it so you tend to see. Now, if you want basically, let me delete this. From the break of structure to this zone, now you want to look out for the 50%. Now, if price did not come to the 50%, which is the discount zone, you tend not to trade up from, right? Now, this is where you get the exact accuracy. Now, if you look basically, after a while, what happened? Price tends to come to this zone. Now, it didn't just take out the 50%, it came exactly to the discount zone, right? And you can see why if let's say this came to this 50% and it starts going to the top, is a good trade. Or maybe close to the 50% you're seeing right here is also a good trade. Now let's look for this other one which is coming. Let me expand my Fibonacci tool. Let me expand it. All right, now if you want basically right now, this first trade now, this one that is going to the top is a cool trade. Now what happened? Also come to the 50%. Now here's the 50%, you can see, which is the golden zone, and it has already, be entering straight to the, the discount zone. And what are you seeing? Basically, you're seeing a pump right now. Now basically this price will just maybe go to the top, then come back and fall to the last one where it will now tap to this other block, and then before going to the top. Now if you tend to enter this trade maybe from here, when it was this zone, you tend to enter it from here and then make your stop loss right here. You won't lose money, you will be on profit, but it is very risky, right? However, all you want to do is for you to wait, allow price to play out the way it wants. Even if you want it is going to go to the top, just don't worry, follow what you've learned and then try to wait for it to come to your exact zone. Right, once it comes to this discount zone, because we already have the discount and the premium zone. The premium zone is where you tend to sell, the discount zone is where you tend to to buy, right? Now once price tend to come to this zone, which is the 50% zone, you can go ahead and buy, or if it's a bit close to the zone, you can go ahead and buy. But once it tend to take it out fully, is also a cool trade, and you can also go ahead and buy. Now this also apply in the sell position. If you tend to look for a good setup and then you see that it has taken out the 50% zone, or close to the 50% zone, or exactly at the 50% zone, then you can go ahead and sell that trade, right? So using strategy, and if you want a setup or you want a video on how you can set your Fibonacci tool, I also want a comment in the comment section, and if I get to see maybe a lot of comments on that, I'm gonna go ahead and make a video how you can set your Fibonacci tool like this one you're seeing, right? So with that said, now you understand how the Fibonacci tool works. You knowing that you must make sure you take it from the breakout structure to that of the last lower low. Now then you look out for the 50% on the discount zone before buying, or in the premium zone before selling. Now with that said, the next one I'm going to guide you through right now is the last scene of this video, which is the rules guiding your structural liquidity, because structural liquidity is the major one you need to be looking at for you to have a cool trade, for you to have that make you a lot of money while trading futures, right? Now starting with the rule one, now you want to know that before you look out for any trade setup, before you look out for any trade setup on structural liquidity, before you say, okay, this is a structural liquidity, in a sell position, it must be a shape, right? Now, what does that mean? Now, if you look basically on this trade, now you want to see that this is giving you an A shape, right? If I get my cursor, now you want to see this and this is forming an A shape, right? You must see an A shape. Let's say I'm looking for a sell position. I've seen my A shape first, and which is a quoting. So if you don't see an A shape in your sell position, it's not a structural liquidity. And not just an A shape, it must be series of candle coming together to form an A shape. And what really happened right here, these are like series of candles coming together to form the A shape, not a wick, right? It's not a single candle, it must be series of candles coming together to form that A shape before you say, okay, this is a structural liquidity. However, the next one is in a bullish position, it must be a V shape, right? Same series of candle coming together to form a V shape, not a wick. Now example, now if you look basically closely, now I want to see that this was a V shape. Let me delete this. This was a V shape right here from this this was a V shape from here, series of candle coming together, and what happened, it formed a V shape, and that's come together, and what happened, it formed another V shape, right? And if you watch, basically this is how it must be. If you don't see a V shape or an A shape in either a sell position or a buy position, do not count that setup as a valid one or a structural liquidity, right? So with that said, the last rule right there is structural liquidity must be at the 50%, which is what I just showed you initially. So it must be at the 50% from the breakout structure of the protected low, which is what I just showed you lately, right? So structural liquidity must either be at the 50% or very close, or to the 50%. Like I just showed you example right here by coming, basically, sorry about this, my cursor is just giving me issues. right? So these are the rules you must follow if you want to have a good trade setup while trading futures, right? So from the break of structure, here's the first break of structure. So is this zone. So you must put your Fibonacci 2 from the break of structure to the last low, right? Now, coming right here, as we said, it was at the 50%, right? Boom. That was cool. So you can see it did not just came to the 50%, it took out the 50% and came to the exact discount zone. Now, if you want basically this other setup you're seeing right here is now inside the 50%. So if you catch this trade right here and then you enter, you should be on profit. And if you want basically this trade is on profit. Now, what was this trade trying to do? Trying to take out this high, like I said initially, trying to take out this high. Then once you take out this high, it will now come exactly to this other block, right? And then it will now go to the top to the full continuation, and that will, this is where we are expected to catch it very well. If you tend to keep looking out for the setup, then you can make a lot of money for yourself. Right now, following these rules I just showed you, you will not be losing unnecessary losses while trading futures, and you will know the exact zone. So all you want to do, the assignment I want to give you right now is, after watching this video, if you watch this video to the end, all you want to do with your phone, you can use an XT exchange. I like using an XT exchange to mark out my setup. Is easy. If you're someone who don't have a PC, you can use an XT exchange to mark out different structural liquidity. Once you mark out them, you write it on your notepad, look out for an order block, and also look out for a QMRO reversal. And once you're done with that, come down below and tell me, Bernard, I've seen an order block, I've understand what the structural liquidity is. And once I tend to see all this comment, that way it will give me more joy and also give more ability to put out more content like this that will make you more money. So with that said, this is going to be it, the liquidity which I've promised you from A to Z. And after watching this liquidity, you can go ahead and watch market structure and advanced market structure on how algo market structure works and the basic market structure works. Then if you're someone who wants to start trading futures, I've made a playlist on how you can trade futures trading with that of Bybit, XT Exchange, and also KuCoin. The two playlists going to be shown right here at the top. All you have to do, click on it, and then I'm going to see you on the other side. Peace.